But on a day like this, and at a moment like this in the market, it's so important to get in. Saurabh Mukherjea joins us right now on the show. Saurabh, really good having you. More so today. Thanks so much for taking the time out. Um, how are you looking at the current scenario, Saurabh? I know in the past you stated that it's virtually impossible for any of us to predict what the markets would do, and therefore you should only try and look at what your businesses or your stocks would do. But I'm just trying to get a sense from you. We've seen a state of fear, then a state of a pullback as well. Do you view this only as a pullback which will get sold into because the news flow around us is negative? Or is it difficult to analyze that also?
Good morning, and thanks for inviting me. At such a sort of interesting juncture for the markets. Look, leaving aside the human tragedy of what's transpired around the world over the last 90 days, from an investor's perspective, this is a mouth-wateringly interesting situation, right? Because you can see what's going to happen in the next 3, 6, 9 months. You can see that in sector after sector, the market leaders who have strong balance sheets, the ability to borrow cheap money on the back of RBI's TLTRO scheme, market leaders are going to go and consolidate their positions. And unfortunately, tragically perhaps, smaller companies, weaker companies are going to get crushed. So just like Demon, just like GST, COVID too will consolidate the hand of dominant franchises, and the theme that I've discussed on your shows over the last couple of years, which is in every sector, one or two players will end up garnering 80-90% market share. That theme will become even more entrenched. It's not pretty from an overall perspective, but making money in the stock market is a sort of Darwinian exercise. Every crisis strengthens the hand of strong, well-run, cash-generative franchises, and unfortunately, it weakens the lesser players. So it separates the women from the girls, so as to speak.
Saurabh, good morning. We've spoken about these consistent compounders every time we speak to you. Mm-hmm. In this period that we've seen this kind of whiplash for stocks across the board, how are these consistent compounders likely to probably cushion the blow for an investor? I mean, we've spoken innumerable times about the likes of HDFC, Bajaj Finance, and these kind of stocks.
Sure.
But these kind of stocks are the ones that have actually gone to cleaners in this.
Right. So if I look at our portfolio, right, if I look at the CCV portfolio, in the first quarter of this calendar year, Jan, Feb, March, we fell 12.5%, and the market fell, I think, around 30%, right? And then this month, like everybody else, we're up around 4%. So from 1st Jan to now, the CCP style of investing is barely down 7-8%. And interestingly, we have a small cap portfolio as well called Little Champs. That's also barely down 7-8% from 1st Jan to now. So that gives you a sense of what I've talked about for a long time, that if you invest in high quality compounders, in a crisis, you fall less than half of the market falls, right? And our reckoning is, as I just said, that companies like Asian Paints, companies like Relaxo, Dr. Lal Path Labs, all big holdings in our portfolio, will have a super time over the next 12-18 months, right? But there's also another way to think about investing in the current context, right? So HDFC Bank, Bajaj Finance, to my mind, those are no-brainers. Just load up on those. We are loaded up heavily on those, and we don't have any doubt that we'll make buckets of money on both of these franchises. So that's the consistent compounder style of investing. But there's another way to think about making money in the current situation, which is think of stocks one notch lower, who've also been beaten up badly, and where potentially the upside over a 2-year, 3-year period could be more. So, for example, in some of our portfolios, we have Axis Bank, right? So yes, HDFC Bank is down, but Axis is down even more. And if I look at, say, if I take the Lehman crisis as an illustration, HDFC Bank recovered very quickly from the Lehman crisis. I would say within 12 months. Less than 12 months. I think within 8 months, HDFC Bank made up the lost ground. But if you take a 3-year CAGR from the Lehman crisis, Axis gave better returns, right? So I think that sort of style of investing could also potentially work. That you take the frontline kings, the HDFC Bank, Bajaj Finance in the case of the NBFC sector, and I would add to that Kotak as a frontline king. These guys are there are buckets of money on the back of the RBI's relief scheme, the rescue scheme. For them, lending and growing in this current environment will not be a problem. But Axis Bank also is flush with liquidity in the current environment. It has a strong CASA franchise. And so in some of our portfolios, we're also increasing our position size on something like Axis Bank. So incredibly interesting position to be in. If you have a portfolio replete with champion players, the frontline champions, the consistent compounders, I reckon, will continue gunning out good returns. The year ending March 2020, our portfolio delivered 10% up. So I'm looking forward to making even more money in the year ending March 21. But what we're also considering is, should we increase our allocation to one rung below the frontline champions?
So what happens, so this downfall, exposed a lot of companies to selling who had a big export business or who had a lot of exposure to US markets, European markets, probably not so much so the domestic exposure. Do you feel then that, probably even in a portfolio when you are accumulating stocks, you should be mindful of business exposures and the external risk factor that you run?
I would put it the other way around, actually. So if you look at our country, barring IT services and auto to a lesser extent, we really don't have that much which is export-centric. So I suppose you have Pharma as well. IT services, number 1, Pharma 2, and auto 3. I think that's pretty much, 70-80% of our value-add exports. We do export, refined oil products and gems and jewelry, but I would count that as more like commodity-type exports, which will recover once the global supply chains are stitched together. So sort of value-add exports, IT services. Do we see a massive challenge in recovery? I don't think so. I think obviously the travel restrictions could have a bearing, but firms like TCS, I think you guys were discussing Infosys a few minutes ago, I think their business will come back. It's probably going to take 3-6 months for their business to come back. But as it is, I think revenues are not going to fall very sharply. There's no reason for in these sorts of annuity-style businesses for the revenues to fall sharply. New business growth could be stunted for a while, but I don't think it's a sort of structural issue. And if I look at the second sector, pharmaceuticals, where we have, say, something like Divis Labs in our portfolio, I think it is almost a given that global big pharma will increase its procurement from India and seek to reduce dependence on China given everything that's fructified in the last 90 days or so. So if global big pharma increases its imports from India, whether it's APIs which Divis Labs supplies or final formulations which other companies such as Sun Pharma, etc. supply, I'm not so sure why the pharma sector is going to be in a bad place, right? And if you then go to the next layer, auto and auto ancillaries, there you could argue there is a challenge, but I think that's a challenge because across the world and potentially in India as well, auto demand could get postponed by 6-12 months. But it's not clear to me that there's a enormous challenge for the export-oriented sectors. Notably, IT, pharma, and auto have strong balance sheets. And whichever of these companies want to raise money, I think we'll probably get some of the cheapest bond market financing in India ever in the next 6 months, right? So these three sectors, I don't think there's a massive challenge. Obviously, there's going to be a revenue growth will stagnate for 6 months, perhaps even 12 months. But I don't think there's an existential issue. Where you'll have challenges is, say, sectors like real estate, telecom, power infrastructure, where balance sheets as it is were stretched pre-COVID. And post-COVID, the financial situation could get a little tougher. So airlines, leisure, hospitality, hotels, right? Heavy balance sheet, capital-intensive sectors which stretched balance sheets pre-COVID. And as they have a tough year from a revenue perspective, they could be in a little bit of trouble. But P&L oriented sectors with cash, the balance sheets groaning with cash, sectors like IT, pharma, and auto, I'm not so sure it's that big a challenge for them, provided the global economy settles down over a 3-6 month period.
Saurabh, just one final question on this interaction, and that is if you foresee any business models that would be changed forever and for the worse off once this settles.
I think why don't I sort of take both sides of it, the better off and the worse off. I think I think what the last 60 days has taught lots of us is you can actually do lots of work very productively sitting at home, right? And the use of collaboration software, things like Microsoft Teams, and for those of you out there who might be using other types of software, it's clear that we can get a lot done from home. And whilst there's a lot to be said for meeting people face to face, I think non-essential travel, whether it's within a city or across cities or across countries, I think non-essential travel will get pulled back for some time to come. Not just because of the cost considerations, not just because of the amount of time it takes up to wake up in the morning, take a flight to another city, but also because of the attendant health risks that it poses, at least for now, right? So therefore, I think that the travel and transport sector, in the broadest sense of the word, I think we'll have to rethink how it goes about configuring its business model. And that's the sort of the difficult the sector where I think there will be business model issues. But on the positive side, the whole aspect of services businesses, including our IT services industry, including our KPO industry, which does so much business with the rest of the world, I reckon the COVID crisis will be an enormous fillip for them, because it would have illustrated to Western companies how much more work they can actually send to India, or indeed to other lower cost destinations. So I would come out of this crisis looking at the situation quite positively for a country like ours, whose main competitive advantage is knowledge and human capital, whether it's via the pharma sector, whether it's via the IT services sector, or indeed for the country as a whole. This is a once-in-a-generation reset, which I think will set the trigger for India's fifth economic boom in 40 years. We've only had 4 booms in 40 years. We badly need the 5th one. And interestingly, before every single economic boom in India comes a US recession. We have never had a boom in India without a US recession. A US recession is a necessary and a sufficient condition for the Indian economy to boom. I reckon the chances are very high that over the next 2-3 years, we'll see an economic boom in India.
Yep, in adversity, we see some opportunity. Thanks, Saurabh, for joining in. Really appreciate you taking out the time.
My pleasure. Thank you. Thanks for inviting me.
Bye. Saurabh Mukherjea there of Marcellus Investment, talking about coming out of this with significant opportunity.